Right, I've done videos in the past related to the active versus passive debate. But in this video, we're just going to talk a little bit about the rationale behind why so many plan sponsors and advisors either lean on or exclusively use index funds. When I say plan sponsors, I'm essentially saying the people that are responsible for choosing the investments that go in your company-based retirement plan. Think like your 401k, for example. The answers to this question are actually many, but this video is focusing on the incentives and the human behavior side of this. So on my website, I have courses related to the active versus passive debate. And when I say passive, I'm using that somewhat interchangeably with index funds. But the factual case for passive funds is actually pretty straightforward, and it comes largely from SPIVA reports that are put out on a regular basis. I'm going to show you some examples of those right here, but what they show you is that over time, virtually all active stock and bond mutual funds underperform their passive counterparts over very long periods of time. So what's a long period of time? In this case, 15 or 20 years. What is virtually all of them? Well, in most cases, in most categories, almost 90% or more of active funds underperform their passive counterparts, which is a pretty significant hurdle. Now, if you're the type of person that thinks that you can pick that 10 or 15% of funds that's going to outperform 10 or 15 years in advance, well, I've got some oceanfront property in Arizona to sell you, along with maybe a Dave Ramsey investing course. Beyond that, there's actually some structural reasons why a lot of this trend towards passive has been exacerbated, and why the trend of outperformance maybe has been exacerbated. And I'm not going to get too far into the weeds of this, but some of it's related to flows. And if you don't know what flows are, I'm going to oversimplify it by saying really just automatic investments going into your funds on a monthly basis. So when you think of the way that the U.S. retirement system is set up now, in the past there was a heavy reliance on pensions. Now that reliance is almost entirely on 401ks. And if you think of your 401ks, in most cases, a lot of you are going to have a monthly contribution to that that's automated based on a percentage or a dollar amount. So let's say you put 10% of your income in your 401k. And for those of you who haven't chosen your investments, what's going to happen in most cases is that you'll be opted into something like a target date fund. And a target date fund in its simplest form, in a lot of cases, is just going to be a preformed mix of stocks and bonds. So let's say it's 60% stocks, 40% bonds, or 70-30. It doesn't really matter. It's tied to your retirement age. But in a lot of cases, those are index funds. And what happens with those flows is that the money goes in every single month in that allocation, really regardless of the fundamentals. People aren't, in those cases, looking at these funds and saying, well, the prospects for the economy are poor, so we'll put less in stocks and more in bonds, and vice versa. They're basically just putting those in based on automated rules. So you can start to see, when you look at it that way, how flows could actually exacerbate this trend towards passive outperformance. There are firms like Tier 1 Alpha that have proprietary data that show exactly how this works. Frankly, it's beyond the scope of this video. Just know that flows are something that definitely people have thought about, and there are some studies that show some of the impacts of how flows work. But outside the effects of the facts of why, in a lot of cases, index funds make a lot of sense, beyond the effects of things like market structure, what is the advisor or plan sponsor's incentive to use these funds sometimes exclusively? When you think about it, it's actually really simple. So the plan sponsor or advisor has two basic jobs. They have to keep their compliance department happy, and they have to keep clients happy. Now, their compliance department means the compliance department at the company they work for or are affiliated with, or in some cases, in the case of the plan sponsor specifically, it would be the Department of Labor, who oversees employer-based plans. And when you look at what happened to employer-based plans over the course of the last decade or so, they came under quite a bit of scrutiny. They also came under quite a bit of legal trouble for failing to meet their fiduciary duties, right? And so in order to keep both the compliance department and clients happy, what's the easiest way to do that? Well, how do clients know how the market's doing? Well, in most cases, clients know how the market's doing based on some really well-recognized indices. Let's just say the Dow and the S&P 500, right? So clients follow the Dow and the S&P 500, and that's really how they judge what's going on in the market. So what's the easiest way, knowing that, to meet client expectations or to avoid the alternative, which is missing client expectations? Well, the easiest way is probably to follow those indices as closely and inexpensively as possible. Well, what's the easiest way to follow those indices as closely and inexpensively as possible? In most cases, the answer is to own index funds. So to illustrate this concept, I'm going to take you through a thought experiment. And this thought experiment is going to involve investing in two separate types of portfolios and strategies. In the first case, we're talking about essentially a diversified buy and hold equity fund strategy. In the second case, we're going to use the same equity components, but add a trend following filter to vary the market exposure up and down. And this is actually real portfolio performance, but I'm not going to explain where it comes from, because the thought experiment would work equally well if it was a completely make-believe strategy. So When we look at these active versus passive debates, what you can see is we're going to take a picture of these two portfolios starting at the beginning of 2008. And what you see is the tactical strategy, which varied portfolio performance up and down, had an average return over a 15+ year time frame of over 9.5% per year. And the largest drawdown it ever suffered was about 35%. That means a top to bottom loss. The buy and hold portfolio had a solid return too, a little over 7%, but its largest ever drawdown was over 50%, right? So knowing what you know about those things, that the tactical model had a 30% higher return, it had a 30% lower drawdown, what do you think in most instances people are going to choose between those two portfolios? As Lee Corso would say, not so fast, because we don't really have enough information to make that decision. Because choosing on past numbers doesn't help us. Obviously, we know what they say about past performance. We can't guarantee it in the future, and it's very true in this specific case. The other thing that's really, really important to understand is that people don't experience average returns over 15-year time periods. They experience returns over very small chunks of time, say 1 or 2 years. So let's change the time frame a little bit. Let's say that instead of using the numbers starting with the recession, let's start of the numbers coming out of the recession. So let's start in 2009. And what we'll see is you get kind of a flipping in the performance between these two portfolios. So the buy and hold portfolio now has an average annual return of over 11%. And a smaller drawdown now than the tactical portfolio, which still has an average annual return of a little over 9%. Pretty big difference, right? So let's make it even shorter. Let's talk about just the last 5 years. And now all of a sudden, what you'll see is the tactical model has an average return over 5 years of just 2.5% versus a buy and hold portfolio return of about 7%. And the tactical model actually has a larger drawdown. So when you start to look at it from that perspective, things change pretty dramatically. So when we start to paint the picture this way, what becomes patently obvious? Well, what becomes patently obvious is that tactical strategies that work really well over really long periods of time can be hard to stick to in periods of underperformance. And so while 5 years might be a really short time frame in market terms, it's forever in terms of the actual human being that's living through that period of underperformance. So what happens when an actual human experiences underperformance? Well, if they use an advisor, they tend to change those advisors. And if they're doing it themselves, they tend to abandon those strategies. And whether that's right or not, that's human nature. So what does this have to do with the actual storyline of the video? Well, if you're an advisor or a plan sponsor and the most profitable path forward for you is to keep clients happy or at the very least avoid disappointing them, and there's a mountain of statistical evidence that says passive outperforms and they're better options than their active counterparts, then why in that instance would you not use index funds? Because ultimately all active strategies, no matter how good they are going to come up against periods of underperformance. And as an advisor, you're going to be left to either justify those or lose the clients. And when you look at it that way, it makes a lot of sense. So with all the positives about index funds, what's the problem with all of this? If you watch any of my videos, you'll know that one of the beliefs that I hold to my core is that financial planning is personal and financial paths are personal. You get what you get from a return perspective, not whatever the market has averaged over any long period of time that you choose. So the thing that so many people seem to have forgotten over the last 15 years is that we do have occasional recessions, and the way that people experience those through their assets can be damaging for periods of decades or longer. And as well as stocks and bonds have behaved over the most recent history, this is the first time in ever that bonds are on track for 3 straight years of losses. In fact, if you bought and held intermediate treasuries for the last 10 years, your total return over that entire decade has been a little over 7%. That is not 7% per year, that's 7% for the entire decade, including all coupon payments over that time frame. And the other thing about this is things break, strategies stop working overnight, and it's exactly at those moments that people abandon those strategies at exactly the wrong time. So index funds are something that I generally view positively. It's something that I use significantly, a huge portion of my own practice as a financial advisor. And you'll know that if you take my courses that I hold a positive view towards those types of strategies. But what you should also know is that becoming a slave to them can have negative consequences. So if you decide to go to the route of an active or tactical strategy, you have to know that you can withstand the inevitable periods of underperformance. And as an advisor, if you give people the advice to invest in those strategies, you have to know that they can withstand that long enough to stick with you to take your advice, because ultimately you're going to be left to justify it. So if you know that, if you can sit through it, and if you know that period of underperformance will inevitably probably be a lot longer than you hope it will be, it's then and only then that you have a chance to succeed with those types of active strategies.